Hey guys, Mike here. So, oh boy, what a day in the market, and you can thank Jerome Powell for putting a little bit of an adrenaline shot right there into the market, especially small caps and all kinds of risk-on assets just went absolutely berserk. And if you don't know what he did, that's what we've been waiting on, right? They have been telegraphing every move for like months and months and months. We don't want to surprise the market and all that stuff. And so we're going to get into exactly what he said and what the real important thing to focus on now is coming into September, okay? And then we're gonna get to all your questions, which you have some really good ones, by the way, and I'm gonna talk to you about those. I appreciate those. And if you can look at this right here, this comes from my friend's old Nicky Leaks here. I ain't talked about him in a while. He's the one that gets a lot of the inside scoop from the Fed anyway. But this is what he was talking about, and this is the key highlights about Jerome Powell and what he said, okay? So obviously he was super dovish, a lot more dovish than I think a lot of us thought he would be. And the key quotes are, the cooling in the labor market condition is unmistakable. We know that. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. That's a good thing. We do not seek or welcome further cooling in the labor market conditions. That lets you know they're worried. The time has come for policy to adjust. That's the big line. The direction of travel is clear, and the timing and pace of these rate cuts will depend on incoming data, the evolving outlook, and the balance of risk. We will do everything we can to support a strong labor market as we make further progress towards price stability. And here's the key too, and I agree with this one. It was the wording, right? He did not use the word gradual or methodical or anything like that. So he has opened this up to do larger rate cuts if needed, and it's all about the job market, which of course is one of our questions we have later on, which I'll talk about. And now it's all about this. Now, I did a whole video on this on 8/15/2024, okay, a couple weeks ago. And it says, this is why the market cares so much about the amount of the rate cuts. And I look back at 25 basis points and 50 basis points rate cuts, and there has been a big difference in history, okay? So now we get to see what is it they're going to do. Clearly by those statements and what he was saying, and I was listening to him, they're worried about the labor market, and they should be. If you go from 3.4 to 4.3, and in a matter of like 6 months or whatever it's been, that's a big rise up. Now, 4.3 is still historically low, okay? But just off listening to you guys talk, right? We all know manufacturing is a hot mess, okay? And I'm reading the comments, I'm asking you guys questions, I'm talking to people what they think and stuff. And so you got 30% of the economy kind of going, ugh, I'm hearing you guys in trucking saying that's slowed down, right? So that's not good, okay? And so it's all about the services. Can they hold up? We're seeing I guess a lot of discount retailers are saying everything's good because we're discounting the heck out of it. But they're all saying the same thing about, even the travel companies are saying people are being very selective, okay, and really cutting back on spending, right? And so we see it, right? We see the credit card delinquencies starting to tick back up, all that good stuff. And so you're seeing those red flags, and the Fed sees it too. The other thing to pay close attention to in September is going to be the balance sheet. Because remember, they're still rolling off the balance sheet. They cut it in June. Remember that? And we're like, oh, there we go, right? And so the market likes that. And so we need to see, when are they going to say enough is enough? Okay, we are done rolling off the balance sheet. It's still like 7 point something trillion. Ridiculous number, okay? But eventually they're going to stop that. Okay, because them rolling off bonds and all that good stuff. Remember, they were the biggest buyer for that whole big bull market from 2010 all the way up to 2020, and actually, I'm sorry, through 2020 once we closed down the world. And so that's what we got looking for next. Okay, and because if they do a big rate cut in September, that really lets the market know, and it could freak it out to go, ooh, man, because they get obviously better data than we're going to get, and they see it before we do. And that lets you know they're really worried about the labor market, and maybe they're too late, and that could freak the market out. So that's what we got to pay attention to. Or is it just going to be the 25 basis point cuts 3 months in a row? That's what we got to pay. Because we only got September, we skip October if I'm not mistaken, November and December. So we only got 3 meetings out of the next 4 months. So pay close attention to that. Now, next one here, which is an easy answer here. I have been hearing about this hard soft landing for 2 years. Is the plane still in the air? And the answer is yes, it's still in the air. We need to see what happens when they do the rate cut. We need to pay attention to the labor market. That is the key right now, okay? Now our next one says, do you have an order of operations to preview before you invest in a stock or ETF? Second question, do you use multiple strategies? Example, I use the growth, hybrid, dollar cost average, 20 the moving averages, dividend, swing, and option strategies. Yeah, I use many different strategies, and I don't have time to go through all of them, but I will say this. One thing I really have started focusing on more than anything else, because I try to keep my portfolio very small now. I started adopting another famous investor's strategy, and just really believing in what I believe in and cutting down the number of stocks. But I'll tell you this, it's about momentum for me. I really started saying, you know what, on the higher time frames, this weekly, you can combine the stochastic with the RSI, MACD, whatever you like. I just like the stochastic with the RSI. And again, I've talked about this before. I'll talk about it again on the weekly time frame. When you get that bullish cross on the bottom, I like to be the RSI above that moving average right there and above 50 before I buy in. And I like to be buying into a strong momentum swing. That's what I want to do. That way I'm not just buying blindly. And I never buy, and these are for bulk purchases, by the way. You're not going to make many. So this is those ones where I go, ooh, higher time frame, great stock. Let me go ahead and put a big order in here and then just ride it up, right? Because I don't want to be buying with stochastics way up at the top and maybe if in a rollover or whatever. I just like to enjoy the ride up on the buy. And then you use this for swings or long-term investing, whatever you want to do. And again, every stock's going to be different. And so you have to be careful when you look through here because you'll say, oh, we got a bullish stochastic cross. Guess what, though? The moving average is trending down. It's below 50, which means the bulls aren't in charge. And we're below that moving average on it, right? But when you get it above that moving average, above 50, and stochastic RSI is moving up, you're going to get a nice little ride up, okay? Now, if we're in a crash, it's going to give you a ride up on those bear market rallies, but it's still going to come back down, okay? Unlike Microsoft, for example, you know, again, you look at this one ain't been below, it wasn't below 50 on the weekly RSI for like over a year, I guess, and it finally just went below 50 recently. But you can see there's many times where you'll see that stochastic RSI gets the bullish cross, but we're not above 50 on the RSI. So I don't want to be in it because bulls aren't in charge. Above 50, bulls are in charge. Below 50, bears are pretty much still in charge at that point in time. You can turn down, and now where are you going, right? And so again, another thing I like to do is you got to recognize an uptrend versus a downtrend, all that stuff first of all. But if you're an uptrend, all that good stuff. Like Microsoft, for example, you know, if you pull up moving averages, like you're never going to buy Microsoft, hardly ever, because it rarely touches the 200. Recently did right there, but it just rarely touches it when it goes on a bull run, okay? And so moving averages are good. You can use those. But I'll tell you, the big thing for me is I like a confluence, right? And so when you get momentum based on top of a trend line, if it has a trend line on it, oh, that really is something I love to see right there because it really increases the odds of it happening for you, right? And so you can look at this right here. Hits the trend line, right? You come down, though. We got the bullish stochastic RSI cross. We don't have the bullish RSI cross yet. So you got to kind of wait. But now you got 3 confluence points where you go, wow, okay, odds are really in your favor now. The more confluence points you can put in there, the better. Okay, but again, that's something I really like to combine is, in any kind of support line, and I'm talking about support line that has multiple touches on it, a ascending trend line, descending, whatever you're doing at the time, whether you're buying or selling. But again, this is what I like to look at. And moving averages, come into play too, because again, if Microsoft does touch 200 moving average, which is rare, it's usually a pretty good buy. Okay, but all stocks are different. So hopefully that helps out. And again, you can see I put this in the Discord yesterday, as a matter of fact. Like something like this, I don't know if it's long term or a swing depending on when it gets there, but like Visa's been getting hammered, right? But you look here and you got this right here is clear resistance, right? You got a volume profile pulled up, which is a gap right here. It's at a resistance line plus all those moving averages means some move's going to happen. So it's either going to break the upside or break the downside. But if it comes down there, I'm like, wow, okay, that would be a cool maybe swing trade just depending on what we're going on with the macro right now. But I almost bet money that thing is going to bounce for sure at that point in time. So it's something I'm looking at. But that's the kind of stuff I look at. I kind of like to look at that kind of stuff. So, let me know what you guys do and what you guys think. Hopefully that helps out some. Next one here says, in your opinion, which government stat tends to move the market a lot when they come out? Example, retail sales, jobless claims. I work a regular job and it's hard for me to manage my swing trades on these volatile days. And the truth is, it depends on what's going on in the market, right? Because what government reports came out for a year and a half and it really moved the market was inflation, right? Because why? We had an inflationary problem. What do we have now? What is the Fed telling you they're watching like a hawk? The jobs market. That's why every single job report comes out is going to be watched. It's probably going to be the one that's going to, move the market the most. Maybe you'll see also retail sales, anything to do with us. Like, are we still weakening? Are we still strong? All that good stuff. And like I showed in Thursday's video, if you didn't see it, I'll link it at the end. But it's all about normalcy, guys. We got to get back to normalcy because what people are doing is, I've noticed, because they want clicks, right? And they want you to feel scared. And so they're putting these charts out that show 2020 to 2024. Well, guess what? Was 2020 normal? Put in the comments, is that normal? No. But if you go back pre-pandemic, that's the levels you need to be watching If we're below those levels, we're in deep trouble on a lot of things, right? Now, if we're below that on inflation, great. But if we're below that, on retail sales and when it comes to retail and manufacturing data and stuff like that, well, that's not good. Okay, and a lot of stuff I showed Thursday, you can see we're right there. So yes, it's dropped a lot because why? They're comparing it to 2020, trying to scare the brakes off of you, right? So of course it should be coming down. Okay, but you need to look at pre-pandemic, like 2017, 18, 19, and then where were we? Because 2020 was a total anomaly, right? And so that's where you need to be looking at when it comes to credit card delinquency rates, whatever it is, that kind of stuff. That's the kind of stuff we need to be looking at right there, guys. Plus, there's more money in the market than there ever has been because all the money pumped in. But if you're above that, great. Where's the housing market need to go? It needs to get back up there. Okay, so that's what I'd be looking at right now. All about employment, all about the consumer. That's what it's about. Because they said they feel fine with inflation right now. It's below 3, whether you believe the numbers or not. I know some areas are sky high, way up there. Remember, you're not upset about the inflation. You're upset about the current prices. I'm telling you right now, that's what it is. Because if eggs go up 7 cents, you ain't gonna notice that. When they were going up by $2, you're like, what? A loaf of bread is $7? Like, what? It used to be $2.50 in 2019. Like, what the heck happened? Then you noticed it when inflation was, they said it was 9%, wink, wink. It was more like 17, I guarantee you. They just changed the way they calculate it. But you see that and you're like, oh, okay. So yes, insurance, certain other things are sky high. But again, it's the prices where they're at right now. That's why I keep telling everybody, I don't care what these presidential election candidates say, ain't none of them can help bring down, because that's deflationary. They're talking about bringing down inflation. Inflation already supposedly coming down. But the prices are where they're at. And so, the only thing I know to bring prices down to go deflationary like that is a recession. So, let me know what you think. Maybe there's a different way it happens. Next one here says, is it me or are these massive liquidity grabs or whatever they are called happening more extreme more often? As an example, on the QQQ today, they slammed it down 4.5 points in under 4 minutes. I've been trading for over 20 years and it really pisses me off. Just seems like they are ripping traders off. You know what it is really more than anything else, because if you're doing this 20 years, you can testify to this. The fact that one, algorithms, right? Even in India now, algorithms account for 50 to 55% of trades in India, but in America it's 80 to 85. So even India is catching up. And the other thing is the amount of traders around the world on a global scale, right? And these different courses are being taught, like ICT. Nobody ever talked about liquidity before. He comes along, he's got a huge following, and then others started following him, and then they got followers. And so you got all these ICT, which basically based on liquidity and certain levels you want to be watching, everything like that. So that's happening. Then you got all these trading groups you never had that just blew up starting in like 2020, 2021. And I'm talking about millions of people in these trading groups. And so an alert goes out and all of a sudden, boom, here they go, global now, boom, they all start going into the same trade or something. And so it's just, that's what's causing that. And with the algorithm, so yes, and it'll continue to get worse because more and more people are doing it. That's why, because more and more people who are considered retail can actually learn it. The resources are there to learn it. The resources prior to 2020 really weren't on YouTube. You had to go pay some really expensive course or something, and people, they didn't have the money or didn't want to do it or were intimidated by it. So, I think that's what's happening. But really, the algos are more than anything else to me, and just the number of traders that are online and awake, especially in Japan and stuff like that during late nights and stuff. So that's just my opinion. Put yours down in the comments if you have a different one. Now, the last one here says, what the hell is a melt up? That's a good question. In the stock market, you'll hear that reference thrown around a lot. Basically, it comes down to this. A melt up is a sudden and persistent rise in price of a security or market, often due to investor herding. Some say that a melt up is just a Wall Street slang, essentially for a market that won't go down and basically pulls up in skeptical investors. And then this one right here, a parabolic price pattern where the price accelerates upward in a steep curve is often associated with a melt up. This can be identified on a price chart. And I'm not sure if this qualifies, but boy, that sure can be construed as a melt up, right? It just won't go down, and man, back to almost all-time highs in a very, very short amount of time. So hopefully that answers your question there. Hopefully you guys got something out of this. Please hit the like and subscribe button if you did. I'll end up putting out a video tomorrow to set us up for the whole week, because we do have a big week ahead coming up here with some major earnings. And again, feel free to sign up for the membership. Feel free to submit more questions for next Saturday's video. Enjoy the rest of your Saturday, and I will see you guys tomorrow.